the ultimate tool for wealth creation. A little bit about me. Well, I'm a real estate owner. I buy and hold strategy. I'm a stock picker, ETF investor. I studied in finance. Remember to like the videos, many more videos to come. Posting at least once a week. Content will be on investing, saving, and increasing awareness, either on investing and saving. So, Robert Kiyosaki is somebody that knows a lot about leverage. Okay, leverage is the reason some people become rich and others do not become rich. And I truly believe this also, because it's really hard to become rich when you're using your own money. Unless you inherit a large sum of money, it's practically impossible to save yourself to wealth. And remember, if you're saving yourself to wealth, you're gonna have to do that for the rest of your life. You don't want to be saving for the rest of your life. You want to save at first, invest at first, and then have a wealthy lifestyle for the rest of your life. You don't want to do something for the rest of your life and sacrifice your whole life and never to live, you know. What the wealthy have to say about leverage? Exactly. That's what I just told you guys, and I think the same thing, because when you're using leverage, you're able to acquire assets, and assets are what produces wealth. It's what gives you returns. If you don't have any assets and you're not using leverage, you're gonna have to use your equity to buy either stocks, bonds, and try to make money off of that. So why you should understand leverage. Leverage gives the ability to increase your returns. Why is this important? Well, you don't need a lot to make a lot. When you're using leverage, you don't need a lot of money to make money. All right. The concept behind leverage, like Al-Shimad said, "Give me a place to stand, and I will move the earth." This is the principle of leverage. When you're using leverage, it's the same thing. It makes it a lot easier to acquire wealth because you're using multiple effects when you're acquiring assets. When you use other people's money and time. What I mean about other people's money, I'm talking about essentially the bank's money, and other people's time is having employees. When you're borrowing money either from your family, from the bank, anybody you know, you're increasing your returns because you're not essentially putting your own money in the system. When and how is leverage utilized? Buying a house with some of your money and borrowed money. When you buy real estate, banks require that you put a 20% down payment, and the rest is finance. Okay, say you buy a 1 million property, you will need $200,000 down, and the rest will be financed by the bank. Now you have an asset that is worth $1 million. You are making money on that million. Let's say the returns of the property is 10%. This gives you $100,000 of profits per year. Now this is a 50% on the money invested. This is a 50% return on the money that you invested. The assets paid cash would have given it 10%. If you would have paid cash for the 1 million property, you would have got a 10% return. This is what I mean when I'm talking about leverage. Leverage multiplies the returns. In this scenario, it was a 5 times leverage. So instead of making 10%, you're making 50%. Now, like with all the power comes great responsibility. Okay, leverage is power. You have to be careful when you use leverage. Okay, you don't want to be using leverage when this goes against you, because like I said, when it goes up, it's increasing your returns, but when it goes down, it multiplies the negative effect. If the real estate market goes down 20%, you will have no more equity in the property. If it goes down 40%, you are $2,000 negative in equity. Therefore, I structure my capital at 50% debt. This is a 2 times leverage. I never use more than 50% debt or 2 times leverage, because if the market goes down 40%, I still have 10% equity in the deal, and I just have to wait, and I won't be forced to sell my properties because I have no more equity. I always use safety, a safety of 50% to make sure if the market goes down, well, I'm not wiped out. When I started out though, I had nothing to lose. Like, remember, when you only have $15,000, you don't have a lot to lose, okay? It might seem like it's a lot of money, but $15,000 is not a lot of money when you want to have financial freedom. I was using 10 times leverage. I was using a lot of risk because I was only putting 10% down when I was buying a real estate property. But remember, the real estate property was cash flowing. All the properties that I bought always had cash flow from the beginning. To know how much leverage you are using, if you want to know how much leverage you're using, you gotta divide 1 by the percentage of the down payment required to acquire the asset. Example, say you have a 20% down payment. This will be a leverage of 5 times. This means that returns are essentially multiplied by 5. Remember, of course, that is a simplified explanation. One should decrease the cost of interest, because when you're using leverage, there's a cost of interest. This will reduce a little bit your returns on your overall equity or the money invested in the deal. For leverage to work, you have to remember this. The returns have to be higher than the cost of interest. Always remember that. How to get infinite returns? Okay, DuPont formula for ROE. This is the ROE that DuPont used to have. Is profit margins times total assets times leverage. This is the complicated version of the return on equity. When you use none of your money and that you make returns on the assets, the return on equity will be infinite returns. It's normal. If you got 1 divided by 0, this equals to infinity. Doing this will also be very risky. If market corrects by 5%, you no longer have equity in the deal. Now, this is the simplified formula for return on equity: net income divided by shareholders' equity, or it could be your own net worth if you're doing this in your own balance sheet. The power of leverage, okay? This graph shows everything of how powerful leverage is, okay? Say you paid $200,000, you put in 100% equity and you have 0% debt. The return on investment is a 4.39%. Okay, you might say this is not a lot, but let's look at how leverage increases this return. When you only use 5% equity and you put down 10%, a 95% debt, so this means you have $190,000 in debt. This will give you a return on 87.75%. As you can see, the more equity you have, the lower the returns, but the more you use debt, the higher the returns. And you can see this is growing at an exponential rate. So thanks for listening. What I'll do is I will add some examples on your drawing board so that people can understand a little bit better when they're buying something. This is the end of the PowerPoint, but I will be adding some examples, practical advice, and where you can use this information. So remember to subscribe and smash that like button. It really helps to support the channel. My goal is to help increase your wealth, because if you can become aware of this information, it will be a lot easier for you guys to achieve the same result that I have. So thank you. I will be going to the drawing board.